The long-awaited September jobs report came in much stronger than expected. Payrolls rose by 119,000 a month, though the unemployment rate ticked up to 4.4%. Yahoo Finance Fed correspondent Jennifer Schonberger sat down with Kevin Hassett, the director of the National Economic Council. He reacted to that jobs report, affordability challenges, and the possibility of being named Fed chair.
I think that if we look at the payroll side, that's correct, that there was outsized growth in education and healthcare workers. Sometimes we see that around September because of seasonals with people coming back to school. But it is true that there's been a sectoral increase over time of demand for healthcare workers. And I think that that's a trend that will likely continue. The thing that jumped out at me that I thought was very interesting in the report was a big surge in construction employment. One of the things that was a high priority for us when we passed the big beautiful bill was expensing factory construction. And so the fact that we're beginning to see people breaking ground on all those new factories that we expect to come up over the next year or two is a really positive sign for the outlook going forward. I think if you look at GDP now, it's running at 4.2% now for the third quarter, and it was about 4% in the second quarter. So that you could say that coming into the government shutdown, this jobs report shows us that it was full steam ahead, this economy, about as good as economy gets. On the unemployment, I think that there are sort of two times as an economist when you look at the unemployment rate where you have to decide what you think about it. There are two ways that you could think about it. One is if labor force participation goes down and unemployment rate goes up, that's a really bad sign. Because what it means is that people are getting frustrated and they're giving up trying to find a job. If labor force participation is going up and the unemployment rate goes up, it could be that it's actually a whole bunch of people who came off the sidelines and they're looking for a job, but it's actually good news because of the labor force participation, not, of course, because of the unemployment rate. And there's a big uptick in labor force participation in this report, which suggests that, the full steam ahead economy that we've created pretty much since we passed the big beautiful bill is getting people off the sidelines and making them look for work. And so if you figure that we got construction people building factories and people cut off the sidelines and looking for work, you'd have to say it's a really strong report.
To your point, Kevin, there were some concerns that the labor market had been weakening until we got this report, putting a rate cut on the table for December. Now that we've gotten this report, looks like that's becoming less likely. What's your reading, and what would the administration's reaction be to no cut in December?
Well, I think that if we look at the news that we got before this report, and don't forget this is a September report, the news that we got between the meeting 2 meetings ago and the last meeting of the Fed, and recall that 2 meetings ago, the Fed was saying, yeah, we're going to cut 3 times. It was pretty much priced into federal funds futures markets. Well, the news that we got subsequent to that meeting, in between the last 2 meetings, was that we had a government shutdown that's going to reduce GDP growth by 1.5%. And we had a consumer price index report that was way better than expected. In fact, it was lower than 48 forecasts that were people who were surveyed at Bloomberg. And so if you've got, before this report, a whole bunch of stuff that would argue in favor of another cut, then you'd have to ask yourself, is this cut, is this in jobs report, is it large enough so it would offset that other news? And I don't think that that would be prudent. I think that the headwind for the fourth quarter is really strong. The shutdown came at just about the worst possible time. I've had airline CEOs coming in and talking to me about how disruptive the Thanksgiving holiday travel season has been, because people will be booking their flights for Thanksgiving, and a whole bunch of people decided not to go on Thanksgiving. So I don't really think that we have a full handle on how destructive this shutdown will be for fourth quarter GDP. We're super optimistic about the future, but I think it would be a very bad time for the Fed to pause.
So it sounds like you think we could see some slowdown here in the fourth quarter before a bounce back next year. I do want to ask you,
because of the government shutdown, yeah.
Yeah, I do want to ask you, though, because the president hinted on Tuesday that he may be starting to talk to Fed candidates for the next Fed chair himself. I know you are on that short list. In fact, you are the favorite right now, according to Polymarket. Have you spoken to the president about this? And if you were selected, what changes would you make if you were Fed chair?
I'm not going to talk about discussions I have with the president. That's one of those things you don't do when you're a White House advisor, regardless of what the topic is. I can say that I'm humbled to be on the list. There's a lot of great folks there, and I think that probably each and every one of them, like me, puts a high priority on Federal Reserve independence, on sound money policies, and getting interest rates aligned with the data. I think to the extent that I'm old friends with Jay Powell, to the extent that we've had disagreements, it's not because he's a bad guy. It's because I think they've made some bad policy decisions. And they've made policy decisions that look to me to be at times partisan. So if you think about it, when President Trump's first elected, then even before he's inaugurated, the December before, they start hiking rates. When we had the Tax Cuts and Jobs Act, which was a supply side tax cut, which should give you growth but no inflation, they started raising rates. And then when Joe Biden came in and spent like a drunken sailor and gave us inflation, they told us it was transitory, didn't do anything about it. In fact, they didn't start hiking the rates to control inflation until after Jay Powell was reappointed by Biden. And then they gave us these surprise rate cuts right before the election, presumably to help Kamala Harris. I think that there's a lot of house cleaning needs to happen at the Federal Reserve, and I'm confident that anyone the president chooses will get to work and try to fix it and make the Fed independent again.
Switching gears a bit, the jobs report showed that wage growth grew by a strong clip of 3.8%, so a good deal above the inflation rate of 3%. Yet Americans still feel that prices are too high. In a new Fox News poll, it shows that some 76% of voters view the economy negatively, and fewer than 1 in 5 think that inflation is under control right now. I know last week you took some initiatives to announce that you are going to lower tariffs on beef, coffee, nuts, spices, and dozens of other agricultural food products. Could we see other tariffs brought down or other carve-outs as you look to improve affordability?
Well, I think that first talking about how people are feeling about prices. You have to go back and remember that we had more than 20% inflation over the Biden years, which really caused significant harm to people's lives. And really, one of the most striking numbers for me that really takes it home is that the typical average mortgage payment when President Trump left office last time was about $1,300 a month for the typical median home. And it jumped because of inflation and higher mortgage rates to $2,500 a month. And so for their homes alone, and you imagine a lot of people have adjustable rates, so they would have experienced a lot of that. For just like getting your house that you then have to put the groceries in, the cost of it almost doubled under Joe Biden. And so, we're reducing inflation, we're cutting the cost of things because we've got a fiscally responsible plan again, and we've reduced the deficit quite a bit this year. Mortgage rates are coming down, but the hole that was dug is enormous. For groceries, I'll go to groceries as well. A typical family in President Trump's last year, spent about $400 a month on groceries. Under Joe Biden, it jumped to about $515 a month. And so they're doing that while their mortgage payment goes from 13 to 25. Of course, there's a lot of work still to be done. But the hope isn't just hope. It's just like practical, I guess, historical evidence is that we're going to fix this. And the way to think about it is that the way you fix this is you get incomes to go up a lot more than prices. And under President Trump in the previous term, you might recall that we got incomes up right before the COVID shutdown. Incomes were up by about $6,500. And so we expect that we can outperform our first term. And if we do, then all of these pocketbook issues will be solved.
But do you think, or could we see other actions, other tariffs being brought down, other carve-outs to help with affordability? Is there anything in the pipeline, anything on the table right now?
Well, I think that there are people who come to U.S. Trade Representative Jamieson Greer every day with requests for changes in the policies. The bottom line is that the purpose of the tariff policy is for the U.S. to onshore production for the things that we can make here and to make our economy more secure and get the jobs to be created here. And so for some things like bananas and coffee, that was never really the intent of the policy. We're not expecting that we're going to all of a sudden have lots of coffee growers in the U.S. I know we've got some great ones in Hawaii, but they don't have the kind of capacity they do in Brazil.
Before I let you go, the president said yesterday at the U.S. Saudi investment conference that he's looking at doing a dividend for the middle and lower class income brackets of, he said, at least $2,000. I know this would need legislation to pass, but is the administration looking at checks of more than $2,000? And while this would help cushion Americans' pockets and help with the affordability issue at the present time, do you worry that that could also be inflationary versus rolling back tariffs?
Well, if you look at what's happened since President Trump took office relative to last year on a year-over-year basis, the deficit is down about $400 billion because of spending reductions, tariff revenue, and surprisingly high tax revenue because we've got a real growth dividend going on right now. And so if we're on track to have about a $600 billion reduction, that's going to be 6-7 trillion over 10 years because of a little bit of growth, then there's room to give more help to people who need it the most. And I'm sure that that's something that President Trump and congressional leaders will discuss as we think about maybe having another reconciliation package this year or next.
More than 2,000, though?
We'll see where it ends up.